Every day, trillions of dollars move through the stock market. But what exactly is the stock market? And why does it matter to the global economy? This is Stock Market Explained, how stock markets work in minutes. Welcome to Wallet Economics. Clear analytical videos about money, markets, and the global economy. Subscribe for more straightforward explanations. Today, the stock market, its role in financial markets, and its link to growth. Short, clear sentences, neutral and educational. No investment advice. List overview. 1. What the stock market is. 2. Why companies sell shares. 3. How investors make money. 4. Markets and the economy. 5. Major global stock markets. 6. Risks and market volatility. The stock market can feel distant, complex, and reserved for a select few. Yet it is closer than we think. Strip away the complexity. At its core, the stock market is a collection of markets where ownership in public companies is bought and sold. Ownership comes in shares, or stock. Own a share, and you own a small piece of that company. You are entitled to a fraction of its assets and profits. Modern markets are digital networks of computers. Trades execute with speed and precision. Access has widened. Financial markets are more connected than ever. A share's price is where the highest bid meets the lowest ask. A real-time negotiation. This is a cornerstone of capital markets, channeling savings to those who need capital. From crowded floors to code, the mission stayed the same: connect buyers and sellers. A company begins as an idea, a dream. Turning ideas into products requires resources, capital, hire talent, fund research, build capacity. Beyond borrowing, there is another path. Sell small pieces to the public. Invite others to share the journey and the potential. This first sale is an initial public offering, an IPO. Publish financials. Explain the model. Share the vision. Work with banks to price shares. Make the case to the world. IPO proceeds go to the company to fund growth and innovation. Once public, shares trade freely. Benefits: raise more later. Acquire with stock, attract talent with options. Markets provide a constant valuation and scrutiny. It is a trade-off, ownership for scale. The bet, a larger pie makes every slice more valuable. An investor commits capital expecting a return. Two paths: price appreciation and dividends. If the company grows, the stock price can rise. Sell higher than you bought. Realize gains. Many established firms share profits as dividends, income paid to shareholders. For income-focused investors, reliability matters. Risk is real. Prices go down as well as up. Market volatility, competition and product risk. Macro downturns can hit everyone. Historically, higher potential returns in stocks compensate for higher risk than safer assets. Investors evaluate companies, industries, and key economic indicators. Capital allocation is a vote. It funds innovation and shapes the economy. Simple idea, powerful effects. The stock market is a barometer of expectations, not a perfect measure of today. Thousands of prices roll into major indices, signaling investor sentiment. Rising markets often suggest optimism, a bull market. Falling markets reflect pessimism, a bear market. Markets look forward 6 to 9 months, so prices can move opposite current news. Investors track economic indicators: GDP, inflation, consumer spending, manufacturing. Central banks move rates. Higher rates raise borrowing costs and can pressure stocks. Lower rates can support them. Remember, the market is not the whole economy. It reflects large public firms, not every household or small business. Still, signals from markets influence decisions across the economy. We live in an era of global stock markets, capital crossing borders at speed. Major hubs: New York Stock Exchange, NASDAQ, London, Tokyo, Shanghai, Mumbai. Each center is a node in a single network. Events in one region can move prices everywhere, instantly. Cross-border investing improves allocation. Money flows to where it can grow. Technology erased many frictions. Diversify across industries, countries, and currencies to manage risk. Trading cycles follow the sun. Prices do not move in straight lines. Volatility comes from new information and rapid reactions. Reports, rules, geopolitics, and science can reprice assets in an instant. Algorithms parse data and trade in microseconds, efficient, but sometimes amplifying swings. The challenge: separate signal from noise. Markets are human. Emotions matter. Fear and greed. Panics can push below fundamentals. Bubbles can float above reality. Yet, markets connect businesses with capital and reflect our economic hopes, a global stage for investment within capital markets. Stock markets connect businesses, investors, and economic growth. Understanding how markets work is the first step to understanding the economy. Thank you for watching. If you enjoyed this video, subscribe to Wallet Economics for more clear explanations about money, markets, and the global economy.